Your 401k balance is lying to you. Every dollar you see on that statement has a silent co-owner. The IRS. Strip out their cut, and in many scenarios, the account with the smaller number is actually worth more. Here is the math that your HR department, your financial advisor, and every retirement calculator you've ever used has been systematically hiding. On the left side of this layout, lock in two identical 401k balances. $1 million each. On the right side, their after-tax spendable value. First balance after taxes, $760,000. Second balance after taxes, $1 million. Look at the massive gap between this side and that side. Same gross number, different account structure, $240,000 difference in actual wealth. Inside this specific box, the fundamental tax timing mechanism that governs both accounts. Compare these two models side by side. Traditional 401k, income skips tax, gets invested, grows tax-deferred, then pays full ordinary income tax on every withdrawal dollar. Roth IRA, income pays tax immediately, gets invested, grows completely tax-free, then keeps everything on qualified withdrawals. Read these exact words carefully. Both accounts have identical total tax. The only variable is timing. But every comparison you've ever seen between these accounts is using the wrong mathematical input. Notice this bounded section right here showing what every analysis presents: $500 to 401k versus $500 to Roth. This comparison is methodologically dishonest. Contributing $500 pre-tax to a 401k at the 22% bracket has a true out-of-pocket cost of $390. Contributing $390 to a Roth costs exactly the same from your actual paycheck. Dividing this frame into the correct comparison model. Left panel, nominal contribution amounts that every calculator uses. Right panel, true equivalent out-of-pocket cost that changes everything. Run the corrected comparison at the 22% bracket. $390 into Roth versus $500 into 401k. When both grow at identical rates, the Roth produces identical after-tax terminal value but with zero tax liability at withdrawal. The Roth wins mathematically in every scenario where your withdrawal tax rate equals or exceeds your contribution rate. This trend line shows the 30-year tax rate prediction that every 401k contribution represents. Tracking the timeline from start to finish, 1913 to 2024. Federal income tax rates over 110 years. Notice this percentage spiking right at this high point. 94% in 1944. Follow this curve as it drops to 28% in 1986, then rises again. The current rate of 37% sits at the historically low end of this range. Look closely at this highlighted term. National debt trajectory. $34.5 trillion as of 2024, projected by the Congressional Budget Office to reach 181% of GDP by 2053. Medicare and Social Security unfunded liabilities combined, $175 trillion according to federal trustees' reports. The Roth is not just a retirement account. It is political risk insurance against a mathematical fiscal trajectory that the federal government itself has published. The employer match that everyone calls free money has legal mechanisms that can make it disappear entirely. Inside this clean panel, the vesting schedule reality that most workers have never read. Median American job tenure, 4.1 years according to Bureau of Labor Statistics. 3-year cliff vesting schedule: if you leave at year 2, notice this percentage dropping straight to 0. The match is legally forfeit. 100% gone. Underneath the surface layer, the behavioral execution data that destroys theoretical projections. 25% of workers with access to employer match fail to contribute enough to capture the full benefit, leaving an average of $1,336 per year on the table per Vanguard research. 41% of Americans who change jobs cash out their 401k entirely, paying income taxes plus 10% penalties rather than rolling the balance forward. The match is powerful when executed. The execution rate is the hidden variable. Phase 1 begins now. The required minimum distribution cascade that turns your retirement account into a tax multiplication engine. Moving down to the second layer, ordinary income tax applies to the forced withdrawal. Moving to the third layer, Social Security benefit taxation threshold is breached, making up to 85% of Social Security income taxable. Moving to the fourth layer, Medicare IRMAA surcharges activate, adding $69.90 to $419.30 per month in additional premiums based on income levels. Follow this curve downward as each layer costs more. For simultaneous tax penalties triggered by the same single required withdrawal. Engineered into the traditional 401k by design. Notice this bounded section on the opposite side. Roth IRA required minimum distributions, 0. Ever. None of these four cascade mechanisms apply to Roth assets. The account that helped you accumulate wealth systematically penalizes you for accessing that wealth. The city you retire in may matter more than the account you choose during accumulation. Compare these two models side by side. High-income earner in California with 13.3% state income tax contributing to 401k during peak earning years. Same earner retiring to Florida with 0 state income tax. Geographic arbitrage value on $1.5 million in 401k assets, $200,000 to $300,000 in lifetime state tax elimination. This specific pattern appears across 9 states with 0 income tax: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. The 401k systematically favors workers who earn in high-tax states and retire in zero-tax states. The Roth systematically favors workers who expect to remain in high-tax jurisdictions throughout retirement. Geography is the multiplier that most analyses completely ignore. The conversion corridor opens between early retirement and required minimum distribution onset. Phase 1 begins at age 60 when many professionals exit high-income careers. The progress bar completes at age 73 when RMDs begin. 13-year window of maximum tax optimization opportunity. Convert $50,000 annually from traditional 401k to Roth at 12% effective rate during this low-income period. Total tax paid on conversion, approximately $65,000. Total future tax eliminated on those converted dollars, $200,000 to $300,000. Net lifetime benefit, $135,000 to $235,000. This strategy appears in no HR presentation, most financial advisor recommendations, or retirement planning software. It exists in the tax code for those who understand the sequential timing architecture. The conversion corridor transforms decades of pre-tax accumulation into Roth tax-free assets at the lowest possible tax cost using the early retirement income window most effectively. If we zoom into this isolated container, the complete decision matrix that determines optimal strategy for every bracket combination. Dividing this layout into contribution tax rate on the vertical axis, withdrawal tax rate on the horizontal axis. Inside each intersection cell, the mathematically superior account choice. Blue cells indicate Roth advantage. Orange cells show traditional 401k advantage. Yellow cells require employer match evaluation first. From step 1 down to step 7, navigate your current bracket and projected retirement bracket through this matrix. The verdict is locked inside the cell where your two rates intersect. For the majority of American workers earning under $100,000 annually, currently in 22% bracket or below, planning 20+ more working years, the sequence is definitive: capture full employer match first, maximize Roth IRA second, return to 401k third. But notice this hidden bonus level that most retirement content completely ignores. The health savings account. Inside this specific box, the only vehicle in the U.S. tax code with triple tax advantage, pre-tax contribution, tax-free growth, tax-free qualified withdrawal. HSA contribution limits for 2024, 4150 single, 8300 family. After age 65, HSA funds can be withdrawn penalty-free for any purpose, functioning as an additional IRA with superior tax treatment. The optimal sequence deployment for most American workers flows through 4 distinct vehicles in mathematical priority order. Step 1. Capture full employer match in 401k regardless of vesting schedule because the immediate return cannot be replicated elsewhere. Step 2. Maximize Roth IRA contribution while in low tax brackets to lock in current rates permanently. Step 3. Maximize HSA contribution if available for triple tax advantage on future medical expenses. Step 4. Return to traditional 401k up to annual contribution limits. This sequence optimizes return on every contributed dollar by prioritizing guaranteed returns, tax rate arbitrage, and maximum compounding time in order. The sequence is not preference. It is mathematical optimization derived from return per dollar analysis across all available retirement vehicles. For viewers earning above Roth IRA income limits, the backdoor Roth conversion mechanism remains available. Non-deductible traditional IRA contribution immediately converted to Roth IRA bypasses income restrictions while maintaining Roth tax treatment. The pro-rata rule applies to existing traditional IRA balances and must be managed, but the pathway exists for virtually all income levels. The account with the bigger number is not always the richer account. The richer account is the one where more of the balance is permanently yours. Traditional 401k builds wealth despite its tax liability, not because of its tax deferral. Roth IRA builds wealth and eliminates the silent co-owner completely. HSA builds wealth with the most favorable tax structure Congress has ever created. Tax law governing retirement accounts has been modified by major legislation 7 times in 40 years. 1986 Tax Reform Act, 2001 EGTRRA, 2006 Pension Protection Act, 2017 Tax Cuts and Jobs Act, 2019 Secure Act, 2022 Secure 2.0 Act. The structural parameters of these accounts change regularly. The mathematical relationships between them remain constant. The question is never which account is better. The question is always which account is better for your specific bracket, your specific timeline, your specific state, your specific behavioral architecture, right now. The matrix provides the framework. Your situation provides the inputs. The optimal sequence provides the execution strategy. Every number in this analysis is correct. Every sequence is mathematically validated. Every strategy is legal, documented, and available to you right now. But the analysis cannot answer the one question that determines whether any of it matters for you specifically. Which version of yourself are you planning for? The version who executes the sequence consistently for 30 years, or the version who intends to? Because the gap between those two versions, not the gap between the 401k and the Roth, is the largest wealth gap in America.